Today we're diving into one of the hottest assets of the past few years, gold. But we're not just going to explain why gold has made a comeback. In this video, we'll walk you through the investment logic behind it, introduce the most important gold ETFs listed on US exchanges, compare their differences, and help you figure out how to pick the right one. If you're even a little bit curious about gold investing, this is the episode you don't want to miss. Gold has always held an important position in financial markets, but for a long time it didn't attract much attention. Ever since the collapse of the Bretton Woods system, gold and the US dollar have had an inverse relationship. When the dollar strengthens, gold usually weakens, and as the dollar became the backbone of global trade, the demand for gold was pushed to the sidelines. For most investors, gold felt unnecessary and inconvenient, but over the past few years, something has changed. What we're seeing is a major shift in the gold investment paradigm. Since the pandemic, the global economy has become more volatile. We've seen inflation spike, geopolitical tensions rise, and monetary policies grow more uncertain. All of that brought gold back into the spotlight. Take COMEX gold as an example. Its price jumped from $2,500 per ounce during the pandemic to a high of $3,700 per ounce. That's more than a 50% gain, making it one of the best performing major assets in the past 2 years. You've probably heard all the typical reasons. Gold is a hedge against inflation, a safe haven during global tensions, and so on. But today, we want to explore a deeper reason why gold has surged, even beyond what most analysts expected. It's because the long-standing inverse relationship between gold and the dollar is starting to evolve. To return to the long-standing inverse relationship between gold and the US dollar that we mentioned earlier, it is important to acknowledge that this dynamic has held for a considerable time and is likely to persist well into the future. However, subtle shifts have emerged over the past few years. There have been periods when both the dollar and gold strengthened simultaneously. My interpretation is not that their fundamental inverse relationship has reversed, but rather that the dollar has lost its traditional ability to suppress gold prices. Historically, this inverse correlation has underpinned predictable market responses to Federal Reserve monetary policy. Typically, rate hikes bolster the dollar and weigh on gold, while rate cuts weaken the dollar and lift gold prices. Following this logic, the Fed's aggressive rate hiking cycle from March 2022 onward, designed to combat inflation, should have triggered gold's steepest decline in 3 years. Yet paradoxically, gold embarked on a strong bullish rally after 2023. This inflection point appears closely linked to a geopolitical development: the onset of the Russia-Ukraine conflict and the consequent wave of Western economic sanctions against Russia. Even Switzerland, long known for its steadfast neutrality, confiscated Russian overseas assets. This raises a critical question for central banks and governments outside the US. Are they prepared for potential risks to their holdings? Might those dollar-denominated assets and other foreign reserves they consider secure actually be vulnerable if another black swan event strikes? The result? Central banks, especially in Asia, began aggressively buying physical gold. So while gold prices have already moved sharply in the short term, this paradigm shift is still only halfway through in the long run. If you want to ride this gold rally, you might think about buying gold bars. But for most investors, gold ETFs are a smarter and more convenient choice. Here's why. First, it's easier. You don't need to worry about storage, insurance, or physical delivery. Second, it's cheaper and more liquid. Gold ETFs trade like stock, with low fees and easy entry and exit. They work for short-term trades and long-term strategies alike. Third, ETFs make portfolio diversification simpler. They can lower your overall investment risk. Fourth, they're more transparent and heavily regulated. US-listed gold ETFs are backed by major financial institutions and subject to strict oversight. But with so many ETFs out there, how do you know which one to pick? There are 5 major gold ETFs we're looking at today. GLD and GLDM are both issued by State Street. GLD is the original heavyweight in the gold ETF space, while GLDM is its low-fee, retail-friendly version. IAU comes from BlackRock, the largest asset manager in the world. BAR focuses on lower costs and clear gold reserve transparency. PHYS is run by Sprott, a Canadian firm known for physical precious metals. It stores gold at the Royal Canadian Mint and undergoes frequent audits. Let's compare their fees and fund size. GLD has the highest fee at 0.40%. IAU and BAR charge 0.25% and 0.17% respectively. PHYS is slightly more expensive at 0.41%. In terms of assets under management, GLD is the largest by far at $114 billion. Next is IAU at $54.6 billion, GLDM at $20.2 billion, PHYS at $12.5 billion, and BAR is the smallest at $1.2 billion. Where they store their gold also varies. GLD and GLDM use vaults in London. IAU has used Toronto in the past. PHYS exclusively stores at the Royal Canadian Mint. BAR emphasizes one-to-one physical backing with regular audits. When we weigh all factors, fees, liquidity, momentum, transparency, and brand trust, 2 ETFs stand out as top choices: SPDR Gold Shares, GLD. Best for institutional investors or those who want the assurance of physical gold backing. It's established, reliable, and highly liquid. The only downside is the slightly higher fee. iShares Gold Trust, IAU, a strong all-around option for most retail investors. It has lower fees, large scale, and is managed by BlackRock, offering brand stability and broad accessibility. This gold rally isn't just a blip. It reflects a deeper change in how investors view gold as an asset class. In our view, gold should have a place in every long-term portfolio, and thanks to ETFs, it's never been easier for everyday investors to gain exposure without dealing with physical assets. Pick the right product, and you can join the global gold trend with clarity and confidence. Thanks for watching today's episode. If this video helped you better understand gold ETFs, give us a like, share it with your friends, and make sure to subscribe to the TradingKey channel. We post daily content on markets, asset allocation, and smart investing strategies. Are you currently investing in gold, or are you just keeping an eye on it for now? Let us know your thoughts in the comments below, and we'll see you in the next video.